Hello friends, good morning all of you. Welcome back to CAP classes. So we are looking at last minute revision videos, and in that this is going to be your next session on the most important accounting standard, that is Accounting Standard 10, Property, Plant and Equipment. So you can hardly find any question paper without a question from Accounting Standard 10. Very important. So let us go to problem number 1. Entity A, supermarket chain, is renovating one of its major stores. The store will have more available space for in-store promotion outlet after the renovation and will include a restaurant. Management is preparing the budgets for the next year after the store reopens, which include cost of remodeling and the expectation of 15% increase in sales resulting from the store renovation, which will attract new customers. State whether the remodeling cost will be capitalized or not. Simple. This is a problem based on the recognition principles of Accounting Standard 10. First, close your eyes, rewind. What is the recognition principle? Any subsequent expenditure towards, any enhancement of the existing facility can only be capitalized if two conditions are satisfied. One, that it gives future economic benefits. That means incremental benefits will come in the future, economic benefits. Two, second one is the cost incurred towards, that development or acquisition can be reliably measured. Both the conditions are satisfied in this question. Clearly they are saying that 15% sales revenue will increase. So what are you waiting for? And another thing, obviously when you are renovating, you know how much of the cost you are incurring for that. So this expenditure can be capitalized and subsequently depreciation will be provided. That's it. So that is your question number 1. Next, question number 2. What happens if the cost of the previous part or inspection was or was not identified in the transaction in which the item was acquired or constructed? Question number 3. What will be your answer in question number 2 if it is not practicable for an enterprise to determine the carrying amount of the replaced item or inspection? Very, 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 very important. Read both the questions again. Read both the questions. These two questions are on a principle called replacement of a significant component or major inspection. So if you read the standard, a component replaced is to be capitalized, and the old component should be de-recognized. This is the principle. That means, say for example, there is a machine. This machine is 10 lakhs. And this includes a component like engine, that is 4 lakhs. Now, new component is, purchased to replace old with, say, 5 lakhs. Now, what are you supposed to do, Carrying amount of machine is equal to 10 lakhs plus 5 lakhs new component minus 4 lakhs. Okay, so I have taken cost, but these should be book values. In your book, after depreciation, WDV will be there, no? Old component, that, you need to do it like this. So this is called, add 5 lakhs is called recognition of new component, minus 4 lakhs is called derecognition of old component. This treatment is same whether it is a component or major inspection. Now third question is, what if I do not have this in my books? When I purchased machine, I wrote journal entry, machinery account debit to bank account. Machinery account debit to bank account. So I don't know what is the value of my old component, and this was purchased, say, 20 years back. Isn't it interesting question? Actually, this is a final question, okay? In final, we calculate the present value. Using time value of money, we calculate the present value of the old component. That is what we call fair value measurement. Ind AS 113. But you don't worry about it. What you need to understand is, close your eyes, remember it like this. In case of replacement of a major component or major inspection expenditure, the new component cost or the new, inspection should be capitalized, and the book value, unamortized book value of the old component or old inspection should be de-recognized. If you do not have that old component book value in your books, still you need to estimate it, fair value measurement. Still you need to estimate the written down value of the old component, and you should de-recognize it. You understand? You should de-recognize. So you might ask, Pavan sir, how can I estimate? Take the new component as the basis. For example, my mobile is there. In this, I have purchased a new battery and I have put new battery. This machine was purchased 10 years ago. Old battery, how much I don't know. And I bought full mobile. So in that mobile, what will be the cost of old component? I don't know. Take the cost of new battery as the basis and work backwards 20 years back. What would be the cost of it? You consider inflation, you consider time value of money, do fair value accounting. That is what the standard says. So what is the answer? If you know the written down value of the old component, de-recognize. If you do not know the written down value of the old component, you have to estimate it and then you have to de-recognize it. This is question number 2 and 3, very important. Then let us go fatafat to question number 4. Entity A has an existing freehold property which it intends to knock down and develop. During the redevelopment period, the company will move its production facility to another temporary site. The following incremental costs will be incurred. Setup cost 5 lakh, rent 15 lakhs, removal cost of 3 lakhs to transport the machinery. Can these costs be capitalized? The answer is nothing doing. Close your eyes, charge it off to P&L. Why? As per accounting standard 10, any expenditure that is incidental, directly attributable to bring the asset into present location and condition only can be capitalized. These expenses have nothing to do with the new asset. You are constructing new house. That is the reason. See, you have one old house, okay? You want to demolish that and you want to build a new house. So you have taken a flat on rent temporarily and you started living in the temporary flat. Now you demolished this asset. Now the question is to shift all my goods to new flat, 1 lakh rupees cost. Rent of new flat, 2 lakh rupees of cost. Can that be capitalized? The answer is nothing. So that new facility rent, transportation expenses, uninstallation and installation of machines has nothing to do with the new factory. So these expenses cannot be capitalized. They should be charged to P&L. That is the answer. Illustration 5. Entity A, which operates a major chain of supermarkets, has acquired a new store location. The new location requires significant renovation expenditure. Management expects that the renovation will last for 3 months, during which the supermarket will be closed. Management has prepared the budget for this period, including expenditure related to construction and remodeling cost, salaries to staff who will be preparing the store before its operating and related utility cost. What will be the treatment of such expenditure? Don't you think this is similar to first problem? Same answer. If the renovation expenditure will result in incremental economic benefits which can be measured, those expenses can be capitalized. Otherwise, those expenses are to be charged to P&L account. That's all. Then sixth question. An amusement park has a soft opening to the public, soft opening, to trial run its attractions. Tickets are sold at 50% discount during the period and operating capacity is 80%. The official opening day of the amusement park is 3 months later. Management claim that the soft opening is a trial run necessary for the amusement park to be in condition capable of operating in intended manner. Accordingly, the net operating cost should be capitalized. Comment. Super question. Quality question. See, normally when you purchase a machine, trial run cost can be capitalized. When you purchase a machine, trial run cost can be capitalized. No doubt about it. Now, this is an amusement park like Wonderland, like Ocean Park, Wonderland. So you have one amusement park. There are so many attractions inside. You will launch this after 3 months. But now what you have done, you started operating it at 50% discount price. If normal price is 100 rupees, you are selling it at 50 rupees only. Why? Because you just want to look at what is the response of customers. So, you opened the park on a trial run. You sold the tickets, customers are coming. Now you are saying that this operating cost will be capitalized. Accounting standard 10 will cut you into pieces. This is not a trial run beta. You opened it, the facility is ready, Customers are coming, though you sold the tickets at a discount, 80% occupancy is not a small thing. So these operating costs cannot be capitalized. The income by way of sale of tickets and the expenses, to run this park for this 3 months shall go to P&L only. This is not a trial run. Over. Next, let us go to problem number 7. Another important problem. Entity A exchanges surplus land with a book value of 10 lakhs. What is the book value of land? 10 lakhs. For cash 20 lakhs, planted machinery 25 lakhs. What will be the measurement cost of the assets received? Very interesting question. Half the students won't understand what this is also. They will ask, Pavan sir, what is this, Pavan sir? Okay, so what is the book value of land? 10 lakhs. So, book value of land 10 lakhs. So, you exchanged it and got. What did you get? You got plant 25 lakhs. Okay, and you got cash 20 lakhs. So, you received cash 20 lakhs. Then plant 25 lakhs. So what is the accounting? That is what they are asking. Simple. Debit what comes in, credit what goes out. Khatam. Debit what comes in, cash account debit 20 lakhs. Plant account debit 25 lakhs. To land account, tada, 10 lakhs. Pavan sir, entry is not tallying. Beta, profit on sale of land to P&L account. Or you can write down capital profit also, because land, it can be credited to capital reserve also. You can write capital reserve also. So 35 lakhs. That's it. Being land exchanged for 20 lakhs of cash and 25 lakhs worth of plant, and the profit recognized in the books. That's all. So basically your plant will be recognized. See, this question is about this part, okay? Because this is the asset that will be recognized in the books, no? That is what they are asking. What should be the measurement? What should be the value of plant? 25 lakhs. That's all. Then, see, this is exchange of, assets with commercial substance. Accounting standard 10, if you read, there are exchange of assets with commercial substance, exchange of assets without commercial substance. For example, imagine I have old laptop. I sold old laptop and I got a new laptop that has commercial substance. If you are my friend, you are using Honda City car, I am using Verna car. You used it for 4 years, I used my car for 4 years. We are bored. Then you said, Pavan, we'll do one thing. Give your Verna, I'll drive for some time, and take my Honda City, you drive for some time. This is exchange of assets without commercial substance. Without commercial substance. If it is exchange of assets with commercial substance, you need to pass journal entry like this. Whatever the asset that is coming, fair value of the asset received, debit. Whatever the asset that is gone, book value of the asset gone, credit. Balance goes to P&L. If there is any exchange of assets without commercial substance, you will not recognize profits or losses. You will write the transactions at book values only. Why? Because it is only exchange of asset without commercial substance. So look at problem number 7. Entity A exchanges, no, this is over. 8. Entity A exchanges car X with book value 13 lakhs and fair value 13 lakhs 25,000 for cash 15,000 and car Y which has a fair value of 13 lakhs 10,000. So much of data, but try to understand. You have given one car, you have received another car. There is no commercial substance in that. There is no commercial substance in that. So what we do is exchanges car X with book value of 13 lakhs. So this is important. My book value of the car given is 13 lakhs. What am I getting? Another car I am getting, and cash 15,000 I am getting. So what I write is old car account debit. No, sorry, new car. New car account debit. Cash account debit to old car. Now, profit on sale of old car cannot be recognized. Old car 13 lakhs, no? No, there is no profit, no loss in this because the transaction is not having any commercial substance. So, you received cash 15,000. Balancing figure, you will give it to new car. That's all. So, being car replaced and the transaction lacks commercial substance, so entry recorded at book value. That's all. So simple. If there is any exchange of assets with the commercial substance, then profit or loss can be recognized. If there is any exchange of assets without commercial substance, usually in the question if they use the same model car or same asset, then you can say there is no commercial substance. You understand? Then you cannot recognize any profit or loss. Very, very, very important questions. 7 and 8 are. Next, let us go to question number 9. Big standard. This is a very big standard. Okay. Oh, 9 kahan ko gaya bhai? Where is question number 9? Hello, question 9. Where are you? This is the one. Entity A is a large manufacturing group. It owns number of industrial buildings. This is about revaluation. Subsequently, that means once the asset is recognized, subsequent balance sheet, assets can either be measured on cost basis or on revaluation basis. Now remember one rule. If you are revaluing an asset, all the assets in that class shall be revalued. If you are revaluing one land, all the lands of company shall be revalued. You cannot say Chennai land I will revalue, Delhi land I will not revalue. Not allowed. So if you are following revaluation model, you should follow revaluation model to all the same class of assets. That is the rule. Based on that rule, this question is there. Entity A is a large manufacturing group. It owns industrial buildings such as factories, warehouses and office buildings in several capital cities. Now understand, one side you have factories and godowns, warehouses. On the other hand, you have office building, corporate offices. The industrial buildings are located in industrial zones, whereas the office buildings are central business district of the city. Entity A's management want to apply revaluation model for accounting standard, revaluation model as per accounting standard 10 to the subsequent measurement of office buildings, and they want to continue historical cost model for industrial building. Beautiful question. Now the question is, can they do so? Both of them are buildings. Now student will say, Pavan sir, all of them are buildings only. No, if they are revaluing some buildings, they have to revalue all the buildings. But hello, hold on. The nature and the usage of office buildings and factory buildings are different. So they can be classified into two different categories. Office building and industrial undertaking. This, factories need not be put under same heading. You can categorize them. Industrial, factories and warehouses is one category. Corporate offices or office buildings is one category. The intention or the contention of the management is correct. You can follow revaluation model for corporate offices or office buildings, and you can follow cost model for your warehouses and factories. Nothing is wrong. This is question number 9. Now let us go to question number 10. Question number 10. Big standard, as I told you. Entity A has a policy of not providing depreciation on PPE capitalized in the year until the following year, but provides full year depreciation in the year of disposal of asset. Is this acceptable? No way. The moment the asset is ready to use, underline, not put to use. Once you capitalize the asset, depreciation meter starts. Today you capitalized the asset, today depreciation meter starts. So the intention of company is wrong. Then question number 11. Entity A purchased an asset on 1st Jan for 1 lakh and the asset had an estimated useful life of 10 years and a residual value nil. Okay, on 1st Jan 2017, the directors review the estimated life and decided that the asset will probably be useful for another 4 years. Calculate the amount of depreciation for each year if the company charges depreciation on straight line basis. Okay, so what is the cost of asset? 10 lakhs. 10 na 1 na? 1 lakh. Life, original life 10 years. So depreciation per annum. Depreciation per annum how much? 10,000. So how many years you used? The machine is used for 2013, 14, 15, 16. So 4 years is used for 4 years. So accumulated depreciation 10,000 into 4, 40,000. So WDV of the asset on 1/1/17, 60,000. Now estimated remaining useful life 4 years only. Now you revised 4 years only. So depreciation per annum will be 15,000 from current year onwards. So what you have to write is a change in the estimated useful life is a change in accounting estimate. The company prospectively has to change the amount of depreciation based on the current WDV and the present useful life. Therefore, from 1/1/2017 onwards, a depreciation of 15,000 per annum shall be charged. That's all. Problem number 11 is over. Problem number 12. Entity B constructs a machine for its own use. Construction is completed on 1st November, but the company does not begin using the machine until 1st March. Comment, depreciation is to be charged or no? Already I told you, depreciation must be charged from the date the asset is ready to use. For example, you bought one generator, okay? Generator you bought and you have put it. It is ready to use. Throughout the year, there is no power cut. When power cut is there, then only you will use the machine, no? So throughout the year, you have not used the machine. Now you are claiming depreciation need not be charged because the asset switch did not even switched on once in the whole year. Beta, nothing doing. If the asset is ready to use, charge depreciation. That's all. That is the solution for this. Next, 13. A property costing 10 lakhs is bought in 2016. Its estimated total physical life is 50 years. However, the company considers it likely that it will sell the property after 20 years. The estimated residual value in 20 years time based on 2016 prices is case A 10 lakhs. What is this? Case A 10 lakhs. That means you bought an asset for 10 lakhs and you will use it for 20 years. After 20 years, you will be able to sell it for 10 lakhs. Okay, or case B, if you can sell it at 9 lakhs, what to do? Simple. The rule here is cost minus estimated residual value divided by useful life. So what is depreciation? Depreciation is equal to cost minus estimated salvage value divided by useful life. So here what is happening? Your cost is 10 lakhs. Minus estimated salvage value is 10 lakhs. That is what the question is. So obviously no depreciation. Since the estimated realizable value is 10 lakhs, there is no depreciation. Interesting, no? Very interesting question. This can come in the exam. And what if it is 9 lakhs? What if it is 9 lakhs? Divided by 20 years. That means 1 lakh divided by 20 years, 5,000 rupees depreciation. So in case 1, when your net realizable value of machine is 10 lakhs, no depreciation. Case 2, when your net realizable value is 9 lakhs, then depreciation is equal to 10 lakhs minus 9 lakhs by 20 years, 5,000 per annum. Question number 13 is over. So we are playing T20. Problem number 14. Entity B manufactures industrial chemicals and uses blending machines in the production process. The output of blending machines is consistent from year to year and they can be used for different purposes. The output of blending machines is consistent, underline. The output of blending machines is consistent, underline. However, maintenance cost increase from year to year and a new generation of machines with significant improvements over existing machine is available every 5 years. Suggest the depreciation method to be used. Now remember, the depreciation method should reflect the consumption of economic benefits of the asset. So, how depreciation method is to be chosen? Depreciation method should be chosen by the management, keeping in view the pattern of consumption of economic benefits of the asset. Based on this, there are 3 methods suggested in the standard. One is straight line method, second one is WDV method, third one is output based method, number of units. Third one is number of units method. In this question they said output will remain same from year to year. Based on this, you have to adopt straight line method. Even if you apply output method also, output is even, no, so it will become straight line only. So in this question, the company has to use straight line method. But if you believe the consumption of, the machine gives you 10,000 output first year, then 8,000 second year, then 7,000 third year, then 5,500 fourth year. If you think this is how the machine will be used, then you can follow WDV method. Since the number of units is even, straight line method is suggested. 14 is over. Now come to problem number 15. 15. Entity A carried plant and machinery in its books for 2 lakhs. Okay. These were destroyed in a fire. Very important question. Very important question. Entity A carried plant and machinery in its books at 2 lakhs. These were destroyed in fire. The assets were insured new for old. That means in case if you lose the old asset because of theft or because of natural calamity, because of something, if the old asset is destroyed, insurance company will not give you cash. Insurance company will give you new asset. So old scooter gone, insurance company will give you new scooter, new for old, and were replaced by insurance company. So this asset is given by insurance company, and you got Sikkim bumper lottery, my dear friend. New machine cost is 20 lakhs. So you lost old 2 lakh machine, new 20 lakh machine you received from insurance company. The machines were acquired by the insurance company, and the company did not receive 20 lakh cash compensation. Insurance company purchased the asset for 20 lakhs and then they gave it to you. How entity A should account for the same? Super question. Read the question once again. Now listen. Fire accident, receiving new machine are two separate events. So that 2 lakh rupees of machine destroyed by fire, you book the loss first. P&L account debit to your machine account, or you can write down loss of machine destroyed, fire accident loss account debit to machine account. So you de-recognize the machine first, charge it to P&L. New machine 20 lakhs is there, no? Beautiful accounting. Income should be recognized in P&L. Machinery account debit, new machine is coming now 20 lakhs. Machinery account debit 20 lakhs to gain, insurance gain on account of fire accident 20 lakhs. And this gain will go to P&L. So you should recognize 2 lakh rupees of loss in P&L for fire accident of old machine. Because you are receiving new machine, not receiving cash, that should be taken to, machine should be recognized as an asset, and the 20 lakh rupees should be recognized as insurance gain in your statement of profit and loss. That is problem number 15. Then, is that all? Yes. So my dear friends, 15 questions we completed in 27 minutes. This is what we call last minute revision. So I hope you enjoyed and this is adding value. Keep watching. Many accounting standards are going to come. Thank you. Pavan Kumar from CAP Classes.